There's a lot that happened in the markets last year. There are many stocks or sectors that have surprised a lot of people on the upside and as well as in the downside. In this video, I want to cover a broad overview of Indian markets this year, which stocks or sectors that have outperformed the market in 2022 and who are the laggards in the year that's gone by. And most importantly, I've made a dashboard to review the entire year's market performance, and I'll tell you how you can access that as well so that you can make better investment decisions in 2023. You'll know all that in this video. Before getting into the visualizations, let's take a quick look at the winners in 2022. The first one unequivocally goes to the PSU banks and the PSU stocks. PSU bank index in the last 1 year has gone up by nearly 70%, not 70%. The many individual stocks, whether it is Bank of Baroda, SBI, Canara Bank, and a lot of other PSU bank, which has given almost 50 to 100% returns, and some even more than that, which is phenomenal considering how the overall market performed in the last year. Is it the new dawn for the sector, or like in earlier years, whenever people started to have too many hopes in the sector, the cold water is just waiting around the corner to pour down on the hope? The jury is still out on this, but till the time the momentum is down on this, people who had stayed put and invested and shown faith in these individual names in the particular sector, I would say well done. And not just PSU banks. If you look at some of the PSU stocks, like Coal India, say for example, has given excellent returns in 2022, along with some of the railway PSU stocks, which has been buzzing on a lot of orders from the government, has seen some euphoric moments in the last 2-3 months or so. The second winner is banks as a sector in general. The bank's credit growth has been an uptrend since a few years, and it just accelerated last few quarters. One of the few reasons why this happened is because of the lot of Swachh Bharat kind of cleanup happened in the past with the banks, the public sectors especially, with all the scams that has come out open, and also the NCLT, bankruptcy reforms, etc. that took place, cleaned up a lot of mess that was hiding, and it took a few years for the mess to get cleaned up and for the investors to build trust and see value in this particular stocks. Not only the banks, the deleveraging that has happened with the Indian corporates during the same period, which is around 2014 to 2016, has left a lot of room for the corporates to expand their balance sheet and helped banks overall in general. If you look at this chart, it tells a story of Indian credit growth rate, which was booming in 2014 and then hit some kind of a bottom in 2017 because of all the reforms and the scams that happened during that period, and then again gone down in 2020 COVID times, and now booming again in the last couple of years. The credit growth rate at the moment has touched almost 17 to 18% in the recent times, and this is maybe 2-3 months old data. So if there is a sectoral tailwind that is helping the banks in general, and with credit growth most likely to stay at almost 10 to 15%, the banks could be the biggest beneficiaries in the coming year also. And this is one of the reasons why banks as an index, banks in general has gone up a lot, apart from the cheap valuations as a reason for the PSU banks. The third winner, in my opinion, is the meme's favorite stock. That's none other than ITC. There were a lot of memes going around ITC as a stock for the last few years. When the entire market was going up, the ITC is one stock which is sleeping or doesn't move at all. It's like a lazy elephant or a Kumbhakarna kind of sleep for a few years. Suddenly it seems like the Kumbhakarna has woken up in 2022 to save the market from other sectors like IT and pharma. ITC in the last year has given more than 50% returns, plus the dividends. The company gave almost on par with fixed deposit rate dividend. That's phenomenal, right? And the other sectors and stocks apart, to me personally, having been watching the Indian markets for the last few years, there's always a fear of FIIs selling in the markets and taking a market down, and there are no flows on the other side, the DIS side, to back up this aggressive selling that we generally see from the FIIs sometimes. This has proven time and again, right? If you look at 2008 and again in 2011, 13, and few other years like that, whenever the FIIs sell, we fall. That has been a trend. But this year, it's really different. There has been a relentless selling that's happening from the FIIs due to the global factors that we are all aware of, whether it is on the interest rates, rising interest rates, rising inflation, or the recession in the West, and etc. etc. The FIIs has sold nearly 2.7 lakh crores in the last year, and the entire selling has been absorbed by the DIS and the retail investors. It's really heartening to see this change. In fact, if you look at the yearly returns of the major world indices, Nifty is up by almost 5%, whereas other major developed indices are down anywhere between 10, 30, 35% in a year. It's there is always in any market, whether it is a bear market or a bull market, there's always few sectors that will go down, few sectors that performs well, and few sectors don't do well. But this year, it seems like the realization has dawned upon the Indian investors to take a small part in the success story of Indian businesses and grow along with the country. So that is, to me, is very heartening to see. So for me personally, the biggest winner in 2022 is the resurgence of Indian investor. Let's get to the visualizations now. First of all, let me tell you the tool from which I took the data from to prepare the visualizations. It's from a tool called Ticker Tape, which I personally use to analyze the stock's performance and use the screener a lot to shortlist the stocks with using different various parameters, the fundamental and technical parameters. So I took the data from Ticker Tape for the stocks which has a minimum of 20,000 crore market cap, along with a few filters on the fundamental analysis side, which I believe is important to understand while selecting a stock to invest. So I then use Tableau as a visualization tool to put this data and visualize this data in some kind of a presentable format to get an overview of 2022 of Indian stock market at a sector level and also at a stock level. Please be mindful that these are not tools which gives some kind of a stock tip or stock advice, but it can give you a variety of ideas on which sectors and stocks can be avoided and potentially could be the underdogs of 2023. Let's get into the sector landscape now. Here you can see the sector on the x-axis, and on the y-axis you can see the 1 year return by different stocks in that particular sector in the last year. You also have various filters you can play around with. One is the market cap filter, basically helps you to filter out the companies that only satisfies above or between a certain market cap threshold. By default, I have set a minimum of 50,000 crore market cap, but if you want to go less than 50,000 crore, you can use this filter just to type down the number, and you can set your parameters accordingly. Or if you want to only view a bunch of sectors, you also have an option to select a bunch of sectors here. There's a lot of things that you can do here, basically to remove the noise. You can, if you don't, there's a lot of since you can see a lot of sectors here. If you want to just focus on maybe 5 or 10 sectors, you can click on these different options and you can view the analysis landscape. You can minimize the landscape to only the sectors of your choice. The other question I'm sure must be running in your mind, how it can be useful. The past is not always an indication of the future, especially in the markets, right? Just because IT didn't perform last year, IT as a sector, doesn't mean that it should not do well in 2023, or vice versa. There are many stocks that we can talk about. But using this, you can decide which sectors has done well in the last year and whether the same sectors will continue their outperformance this year, or are there any bottom fishing sectors that you can consider nibbling in, which are going down, which has already gone down a lot. So I'll take an example of 2022. If last year you would have completely avoided these sectors like IT or pharma, which has gone down a lot, whether you take the names of Wipro, Tech Mahindra, or Infosys, or in pharma there's a bunch of names. If you avoided some of these sectors and picked some of the PSU stocks and ITC and some of the PSU banks and banks instead, you would have beaten the market by miles and sitting at the end of the year with a lot of gains. So this could help you to, this landscape could help you to choose the sectors that you can consider and the ones that you can avoid. Let's get to the stocks landscape now. I've plotted the graph into two axes. The y-axis has the average 1 year return of the stocks, and the x-axis has ROCE plotted against it. The ROCE is nothing but, in fundamental analysis we call it as return on capital employed, and all the dots that you see here on the screen are the or each stock that is performed against these two axes. And I've plotted a constant line on 0 on the x-axis and 0 on the y-axis, just to give you nice quadrant feeling, to tell you which stocks is falling under which quadrant. But before getting into detail on the landscape, on the visualization, and how you can utilize the visualization using different filters to shortlist the stocks, let's address the elephant in my opinion, that is ROCE. What is ROCE? I'm sure all must be having this doubt. ROCE, return on capital employed, is a financial ratio that measures the profitability of a company in relation to the capital it has employed. The formula of ROCE is nothing but EBIT divided by capital employed. EBIT is nothing but the company's earnings before its interest and taxes. Capital employed, on the other hand, is a total amount of capital used by a company to generate profits. This includes both debt and equity capital. So to calculate ROCE, you first need to calculate a company EBIT and capital employed, and then divide the EBIT by capital employed. The result is expressed as a percentage and represents the return on the capital that the company has employed. ROCE in particularly, in my opinion, is a very useful indicator in comparing the profitability of different companies, as it takes into account the amount of capital a company is using to generate the profits that it is generating. For example, high ROCE indicates that the company is generating a higher level of profitability from its capital, whereas low ROCE may indicate that a company is not using its capital effectively. Let's take a quick example. Imagine that you own a company and have about $100 of capital that you can use to generate profits. This capital can come from a variety of sources, such as loans, investments from shareholders, or profits that you have retained in the business. Now, let's say that over the course of a year, your company generated about $20 of profits before paying interest or taxes. This is your EBIT. So to calculate your ROCE, you would divide your EBIT by your capital employed like this, something like this, where ROCE is equal to $20, which is your EBIT, divided by $100, which is your capital that's employed. If you calculate this in a percentage wise, you will get about 20%. This means that your company has generated about 20% return on the capital that you have employed. The more the company is capital efficient, it means that the company is utilizing its cash well to generate certain X percentage of profits. With that out of the way, let's get into this stocks landscape visualization. This is a visualization where if you look at it, you have, I've explained the x-axis and the y-axis already, and you have different kinds of filters with which you can shortlist which stocks fall under which kind of criteria. For example, I have a filter that is on the 5-year CAGR returns, and there is another filter on the PE ratio, price to earnings ratio, and there is another filter on the 5 years revenue growth, how much revenue growth that the company is making year on year. So if you want to, how do you use this? How can you use this? There are different ways that one can use this. For example, if you want to pick up, if you're someone who is a value investor, want to pick up stocks that is of less PE, say for example. Then you can use this filter to say type in 0 to 10 PE and say I want to shortlist the stocks, all the stocks that are in 0 to 10 PE, and then you can see all the stocks that are here between you have your BPCL, SAIL, that is having an ROC of 22%, and then you have the right end, which is Naukri, which is having an ROC of 73%, but has down in the last year for about 28% because of all the new age listings has down, right? This also is not an exception in that case. And then you have right above this, which is JSW Steel, GAIL, Oil India, IOC, and some metal companies, which is Hindalco, and all the things that are there. You can look at it here, for example, in the bottom pyramid here, you can see which are the companies that are giving high ROCE but has given negative returns in the last 1 year. Maybe pick up Vedanta, which is also a very highly dividend company. If this is not how you want to do it, maybe you can refresh everything and pick up only those companies which are generally giving consistent returns in terms of the stock returns are concerned in the last 5 years, but has down a lot in the last 1 year. Case in example, IT. There are a lot of IT companies which are very capital efficient, but down a lot in the last 1 year. There could be other sectors that is there, we don't know. You can shortlist that by using this. For example, here you want to shortlist, you want to filter out all the stocks that have given a minimum of 10% CAGR returns in last 1 year. Then this is what you can see. And you can also use another filter in this, and you want to shortlist the stocks which has grown in terms of the revenue is concerned, minimum of 10%, and also their stock returns is also minimum of 10%. So I'll type in 10 here. So this will filter out the stock, your selection of stocks even more here. So here you can see a bunch of companies that can be considered as a value buys, because this is the Divi's Lab is something which has gone down a lot, or Astral Pipes, Asian Paints, and the bunch of companies that are that are very capital efficient but has gone down a lot in the last 1 year. And also these companies has given consistent returns in the last 5 years. Only in the last year there is a blip because of whatever factors it may be, and this could be considered as reasonable investments. And there are other stocks which you can see which is given higher returns. You can see, and there's a lot of other stocks like this Timken, Jindal Steel, Metals One. There's a BEL which is on the which is a PSU stock again, and so on and so forth. So the whole point of this two visualizations is to help you to shortlist the stocks using different filters so that you can make better informed choice and investment decision in 2023. I hope this is useful. You can find all the links for these two visualizations that I have demonstrated in the video description below. Please let me know whatever you feel about it. Any comments in the comment section below. And this is Pawan, and I'll see you in the next video.